I know that everybody loves price action trading and candlesticks, so in this video I want to take it one step further, and I have compiled 4 advanced candlestick and price action trading secrets, which are basically strategies that you can use, and I've included a lot of step-by-step trade studies that you can use on any chart and on any market. So let's get into this video. And what I will do in this video is I will follow a multi-time frame approach, whereas we start on the higher time frame where we want to look for, okay, what is the general direction that the market is going into? And what is our bias filter? Do we want to trade? Yes or no? Because not every time when you look at a chart, it automatically means that you should be trading it. You should look for the market and you should look at the higher time frame and ask yourself, is there something interesting? Is there something worth trading? And only if the answer is yes, then we will go to our lower time frames, and that's where we develop a trading plan. That's where we execute the trade. That's where we set our stop and our target. That's also where we manage our trade and where we exit the trade. Once you're on the lower time frame, that's where you typically stay. You typically don't jump back to a higher time frame because you have already confirmed that what you need from the higher time frame is there, and then everything that you want to do when you're in a trade or when you're looking for a trade to actually execute it, it happens on the lower time frames. So let's do that. Let's talk about the first concept and the strategy, and I call it pivot meets engulfing. And what does this mean? So when we are on the higher time frame, which in this case is the daily time frame, we want to look for something that really stands out. So we have a few things coming together. We have here a trend line. When we connect the highs here in the downtrend, we see that this is an active trend line. An active trend line has at least 3 touch points, which is here given 1, 2, 3. And here on the 4th touch point, we are still first of all respecting the trend line, so it makes sense to look for a trading opportunity here. And the second thing that is really interesting is the type of candlestick that we're getting. This is an engulfing candlestick. It means that the whole range from the high of the low of this candle is completely engulfing the previous candlestick. And in this example, it's engulfing the previous 1, 2, 3, 4, 5 candlesticks. So this candlestick has a range that is larger than all previous 5 candlesticks. So this is a very significant finding. This is a very, very significant candlestick. And at that point, what I would be doing is I drop to the lower time frame, because this gives me the signal that I want to look for short and selling opportunities, but I don't want to short just yet. I want to find the perfect opportunity on the lower time frame. And here we are now on the 1 hour. And you can see I have a weekly pivot point here, and this is just a central pivot point. And what you will see is that during an uptrend, the market is staying above a pivot point. During a downtrend, the market is breaking below pivot points and staying below central pivot points. So when a market goes from trading above it to trading below a pivot point, that's a very meaningful signal. Here you can see in this vicinity of this area of where the pivot point is, there's also a very important level. We have previous resistance that turns into support and is being retested multiple times. Here's also the 92.5 round number. And now it seems like the market is making a huge run for the pivot point. You can see we're really moving down quite a bit, which is our engulfing candlestick on the higher time frame. What we see now is a dirty retest. And I made a video or 2 videos about a dirty liquidity retest in previous videos. And now we're dropping to an even lower time frame. So we're going from the 1 day to the 1 hour to the 5-minute chart. And here is where we want to look for entries. And an entry criteria or an entry tool could be a trend line breakout. So what we want to do is we don't want to enter just because the market has made a big engulfing candlestick. So this is our engulfing candlestick on the daily. This is how it looks on the lower time frame. And typically something worth keeping in mind on is that the longer a move goes, the higher the likelihood that you will soon have a retracement. When you look left, this is very true. When you see that the market is going higher, eventually it will stop and the market may move back a little bit. It moves higher, it moves back a little bit. It moves higher, it moves back. It moves higher, it moves back. So this is the typical rhythm. So if you want to short, the last thing that you want to do is you don't want to short into a very strong price move. You want to short after a strong price move when the market is moving back up a little bit. And this is where our trend line comes in. So after this big push, we wait a little bit. We wait for the market to relax. We wait for the market to give us here a consolidation. Then we drop to a lower time frame, and there is where we get our signal. Now you can see the market has moved lower and it has pulled back a little bit. So now we may be looking at the early situation and the early phases of the next push. So we are wanting to trade another bearish wave, and we want to trade another bearish wave after the bullish wave, because there's always this back and forth that I just showed you. So we want to wait for this back, and then we trade with the forth, so to speak. And the trend line here gives us a perfect signal. We see that the market is a trend line here. It shows us here a lower bounce. I call this a breakout buildup, where the market moves into a level and pulls back a little bit, but is not even able to come close to what we were seeing previously. And then we have a breakout, and you can see afterwards the market really unfollowed. So you can see this is actually what happened. We have a big push, which is our engulfing candle. Then we have our consolidation, and then we have another big push. So this is the typical and ideal situation that you want to look for, higher to lower time frame, and this is how it can unfold. Another very important thing to look for on your higher time frame is a structural change. And the structural change looks in an uptrend, something like that. When you see that in an uptrend, you are suddenly making lower highs. That's a structural change, because usually in an uptrend, like here, you see the market is making higher highs and higher lows. In a downtrend, you see the market making lower lows and lower highs. Whereas in an uptrend, when you see the market is not able to get above a previous high, that's a very, very important finding. Another very great confluence factor is that the market is at a previous high point. This is a historic area, a historic price level, where the market was not able to push higher previously. So a very important factor. Now we can drop from our higher time frame, because now we know we want to short this market. We don't want to short here because we want to wait for a better opportunity, but we know that we want to short it. So we go to the lower time frame, and this is how it looks. What do we see? We see a trend line. You can see we have an active trend line, 1, 2, 3 touch points. We have a structure level, previous resistance turns into support, and that is a good idea. So our trading plan could be simple: wait for the breakout and wait for the market to get below all of that, which it did here. You can see we have a breakout buildup. The market moved into the level, pulled away a little bit, but was not able to get really far away from the level. Then we have our breakout. And you can see we added a pivot point here, and the pivot point is just such an important thing. If we get below the weekly pivot point, the chances of actually following through into the direction are very, very high, especially if everything is coming together like it did here. We have a higher time frame bearish setup. We know we want to short based on the higher time frame. We just don't know when. Then we go to the lower time frame, and we see that we have a trend line break, we have a structure break, we have lower highs, and we have a weekly pivot point break. There's so much coming together. And you can see when we just follow through, you can see the market really moved lower quite a bit. You could have used other re-entry opportunities, such as using here a horizontal breakout, and that may also be an option. So I call the next concept the 3-candle reversal magic. It is my favorite candlestick pattern. It consists of 3 candlesticks, and it is absolutely magic, as you will see. It's very simplistic, but it works exceptionally well. So on the higher time frame, what we want to look for is where are previous key levels. So this is a key level. Clearly, the market went from downtrend to completely turning into an uptrend. So something very, very significant has happened here. This is a market or a level that you need to pay attention to. It's also the 128 round number, so great confluence. And when we zoom in, you can see here's our candlestick magic. And what does it mean? We are going from a strong bearish momentum. So you can see we have 3 candles of strong bearish momentum. The market is moving down, down, down. Then we suddenly have a doji where the market is not able to push lower. And then we have the final piece to the puzzle, a bullish candlestick. So we're going from strong bearish candlestick to indecision to strong bullish candlestick. So this is a great, great reversal. Also, if you would put a RSI indicator on your charts, you would have a divergence here because the market is not really convincingly making a lower low. So those are all the things we need on the higher time frame. At this point, I know that I want to buy this market. I want to go long. I just don't know when. So now we go to the lower time frame and we keep that in mind. We keep in mind we want to be long. We just have to find something that makes actually sense. And what do we have here? We can start mapping out our lower time frame. So we look for trend lines and structures. We have a previous support that turns into resistance. The market has already broken it. Good. We have a big trend line that the market has used as support or a resistance and now is using it as support. We have another big level here that the market may run into very soon. We can add our pivot point, and you can see something has clearly changed. We're going from trading underneath the pivot point to now trading above it, and we're retesting it as support. So very bullish signal. We are having a little bit later a triangle pattern, so we're moving back into the level that we identified. And how are we moving into the level? If you have watched my recent chart pattern course on YouTube, you will know that this is a very, very bullish signal, because although the market is not initially able to break the level, how is the market moving into it? It's moving higher with higher lows. So every time there's a pullback, the buyers come in earlier and earlier and earlier and keep pushing the price up. So very, very bullish signal. So what do we expect? We expect maybe a breakout here, and that would be a very interesting signal. We could trade a break and retest. This is what actually happened. We have a breakout that immediately fails. And this is something that I've been discovering over the last few years more and more. Breakouts were very profitable a few years ago. But recently, the last few years, breakouts have become less and less profitable initially. However, there is a way to really nicely trade breakouts nowadays. And this is with a dirty liquidity run. So what you have often is a breakout and the market falls back very deep into actually what has happened previously. So we are testing the pattern. A lot of traders who were long here are now either being taken out or they're sitting on a huge loss. And this is what you call a liquidity run. And the market will not always do that. If the market comes back around a second time, this is then your final long signal, your final buying signal. So now you can see the market has really squeezed all of those traders here that bought a breakout too early, or well, not too early. Sometimes those breakouts will succeed, but there's just a smaller chance these days. Everybody who was squeezed is now looking at this. Not everybody will still be in this. A lot of stop runs will have happened, but if you see this and you have not traded the first breakout, or even if you have traded the first breakout, this is a great opportunity to go long, because this is now usually a much, much more highly reliable signal. And again, there is the chance of a secondary liquidity run. And this is where we get into this fractal nature of the market, in this rhythm. You have a breakout, liquidity run, breakout, liquidity run. So what is very important about this is that if you see a market is prone and likely to do liquidity runs, you have to factor this into your stop loss approach. Use a little bit of a wider stop loss. Don't be so tight with your stop loss. Give your trade some room to breathe, especially if you see that this has happened in the past. If you see there was a liquidity run, just the last signal, give your trade room here and don't suffocate the trade. And then you may be able to make those liquidity runs and those breakouts really work for you. So pay attention to this pattern. A lot of traders who are struggling with breakouts, this could be your fix to actually making patterns and breakouts work. Next is our continuation reversal. That sounds a little bit contradictory. How can a continuation be a reversal, or how can a reversal be a continuation? But let's look at what I mean. So on the higher time frame, we have a few things coming together. First of all, we are below the moving average. And I read, my favorite trading book is from Marty Schwartz, who was also featured in the Market Wizards book. And his own book is called Pitbull Champion Trader. And he was using a moving average. I'm not sure if it was the 100 or it was something lower, but he was using a moving average as a way to filter the direction. If the market is below a specific moving average, you only look for shorts. If the market is above a moving average, you only look for buying opportunities. In this case, we are below the moving average, so that could be our first filter. Then we look for pullbacks. We want to see the market move back into previous resistance, for example. And we want to see that those resistance are holding. Just because the market is touching a previous high, it shouldn't mean that you automatically go short. We wait for the market to actually respect the level and then move away. And at this point, we could say, okay, now it makes a lot more sense to drop to a lower time frame and look for a shorting opportunity. So now on the 1 hour, this is what we get. we have a very, very strong trend line. You can see 1, 2, 3, maybe even 4 touch points. This is our dotted line that we have from a higher time frame. And we can even keep the moving average on our chart, and you can see it nicely aligns with the trend line. We can also add my favorite pivot point indicator, the weekly pivot point, and you can see how nicely it lines up. Now a trading plan could be we wait for a break and retest. And you can see this is what happens. We have the breakout, and the retest happens a little bit later here. We have a retest of the moving average. And the moving average retest happens with a flag trend line. And you can see the flag trend line broke. The market tested another pivot point, rejected it, broke below the low, moved lower. And this is a very, very common pattern. You can start paying attention to it. You will see that often the market rolls over. If the market turns from an uptrend to a downtrend, the market typically retests the pivot point from underneath. If not, at least you will get a very, very close retest. Here you get actually a rejection. So look for those rejections, look for those retests underneath moving averages, underneath central pivot points, and then look for trading opportunities away from them, and look for opportunities in the direction of the higher time frame. And those could be really, really interesting strategies, and those can be the foundation of something that you trade. So let me know in the comments below which of those concepts do you find the most interesting, and I may make a video specifically about what you suggest.